we have two ways to go from here. Either the market's going to come back down and retest this 100-day moving average, or we're going to break above this trend line and make a move back up towards 6,100.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here back at the end of the week for another weekly market recap with my good friend, the tub-thumping Lance Roberts. Lance, how you doing, buddy?
I'm doing good. It's we're a day early. It's Thursday, so the stuff we talk about today hasn't actually wrapped up the end of the week yet. So we'll have to take some of the things. We're going to make some assumptions about tomorrow. See
Yeah.
how this week ends up.
And folks, the reason why we're recording a little early this week is because if you're watching this when this video initially releases on Saturday, Lance and I will be at that exact same time at his conference for his firm, RIA, Real Investment Advisors, Real Investment Advice, out in Houston, Texas. So we'll hopefully be having a great time doing that while folks are hopefully having a great time watching this video, Lance. All right, well, look, you didn't ask, but I'll tell you anyways. Tub thumping. It's actually a real word. It's not just a Chumbawamba song. It means expressing opinions in a loud or dramatic manner. And I thought, you know what, that's a great adjective for Lance.
Pretty much, yes. I do have opinions, that's for sure.
Okay.
That's my
And
wife.
you're not that quiet about him either. Exactly. I'm sure your wife would corroborate that too.
Exactly.
All right. Well, look, Lance, kind of interesting times in the markets. They were definitely showing some weakening, which we talked a lot about last week. They've kind of caught a bid a bit this week. So love to get your reaction to that. And interestingly, one of the things that kind of helped add wind to the market sales was the recent, or appeared to add wind to their sales, was the recent inflation data that we got, which, wasn't spectacular, but it wasn't as big as the market, I guess, was expecting, and the market is sort of having a little bit of relief rally in response to that, apparently. So, how do you want to tackle this?
But I mean, we just kind of work in a couple of directions. First of all, the weakness that we've seen really since the end of December and then really the first, 2 weeks of January so far, has been absolutely normal. We had everybody tends to forget when we go through these periods of correction, we start getting lots of emails. It's like, oh my gosh, when's this sell-off ever going to end? Okay, calm down. We're down like 4% from the peak. And, we were talking about back in early December, said, hey, look, this market's really extended. We're about to go into mutual fund distribution periods. We're about to go into corporate share blackout ahead of earnings. And that's a major buyer of equities that evaporates from the markets for several weeks. So this correction that we're watching right now is, or I've been through, actually, it's almost over now, but is simply working off that previous overbought extended condition. We had a lot of bullish sentiment in the markets. That's been mostly reversed now. Corporate share buybacks have been absent. Those actually start back today. The window opens back up today. JP Morgan kind of kicks off the official announcement period. We have the major banks, JP Morgan, Goldman Sachs yesterday. We've got some more banks today. Regional banks are really kind of coming in right now over the next few days. And then about a week or so, not this coming week, but the following week, we'll get Apple, Microsoft, Google, the big boys, right? So once they announce, their window to buy shares opens back up. Now, this year, the expectation right now, based on all the announcements that have been made, is that share buybacks will exceed for the first time $1 trillion. And it's like, oh, we just throw around $1 trillion and $1 billion like left pocket change these days. But that's a massive amount of buying of corporate shares this year, and that's going to provide a bid. And if you go back and look at the ebbs and flows of corporate share buybacks and the ebbs and flows of the stock market, there's about a 90% correlation between those two. So basically, when corporations go into blackout and they can't buy shares, markets tend to decline because you're removing a major buyer from the markets. When they're engaged in buying shares, markets tend to go up because they're a major buyer of equities. And we've talked about this before, going back to the turn of the century. If you net out household purchases in terms of what households sold versus what they bought, international, what they sold and what they bought, pension funds and hedge funds, what they sold and what they bought. So you net all that out. that is about flat. All the buying that is done in the market, almost 100% of net equity purchases since 2000 has come strictly from corporations. So, that's been a major driver, particularly over the last 15 years in particular, really kind of starting post financial crisis. Buybacks kind of really went on to steroids, and that's been a major driver of the market. So that's one thing that's now ending. So markets are oversold or deviated. The buybacks are about to start, so that's going to give a bid to markets. And so a lot of this other stuff that you get, this headline stuff, it's like, oh my gosh, markets are selling off because of fears of inflation. No, it's really not. It's just you've got a buyer out of the markets. But we've talked about before is that as humans, we have to rationalize why something's happening, right? So we try to assign a headline to what's happening in the market. Say, well, the market's selling off because of this. Sometimes there may be an effect of that because it's movements of sentiment. But at the end of the day, it's really all about the buy side and the sell side, and do you have more buyers than you have sellers? And that's when we talk so much about money flows and how flows are coming into the markets. And since the beginning of the year, we've had negative money flows as of and it's interesting if you take a look at a chart of the S&P, while there was a lot of angst about the CPI and the PPI report on Tuesday and Wednesday, on Monday, buyers were buying ahead of the report. We saw the market open below the 100-day moving average, close back above it by the end of the day, had buying all day long. On Tuesday, after the PPI report, the market sold off and then rallied back all day. So buyers stepped in, started buying that market ahead of the CPI report. So the market knew what the CPI report was going to do. Retail investors were sitting there wringing their hands, trying to get out of the market ahead of time. But that's why that's why you watch money flows, because money flows were turning positive, even though there was all this angst in the market. So if you pay attention to money flows, they'll keep you on the right side of the trade more often than not.
Okay. Well, when we pull up the chart of the S&P and do the technicals, maybe we can look at what the latest money flows are telling us on that. But it sounds like they're on the rise.
Yeah, absolutely.
Yeah. Okay. So I guess before we move off inflation, so the number came in, I think for CPI came in at like month over month 0.3% versus expectations of 0.4%.
Actually, it was 0.4 versus the expectation was 0.5. And then the core was 0.3 versus 0.4.
Okay, core. All right. Sorry, that's what I was thinking. All right, but okay. So, a little bit better than folks were thinking. Now, of course, right up until this week, everybody, had been looking at the recent inflation data we had gotten up before this week, and it wasn't looking super encouraging. So, how much of a game changer, as I know is too strong of a word, but how much of a sentiment shifter is this recent data? Is it just, oh, okay, maybe things aren't as bad as we thought, and we're going to keep our eyes open? Does it have more weight than that? Does it have less weight? What are you taking away from this report?
Well, no, I mean, if you dig down into the CPI data, and you continue on this trend. So first of all, if we go back and look at CPI over the course of the last 25 years, right? Just go back to the turn of the century. It's hard to believe it's like we're talking turn of the century 25 years ago now. It's how old you and I are getting.
I know. A quarter of the century is already behind us here. Yeah.
So, as we look at that, look, CPI is not stable at all. It jumps wildly from, above and below, and over time it's averaged about 2.4%. So you have to remember, when the Fed talks about a 2% target, they're rounding down. So 2.4, you round that down because it's less than 2.5, right? So if it's above 2.5, you'd round up to 3. So their target's 2, which is really 2.4% of inflation. That's been the average since, and that's a great chart, thank you. So you see how volatile CPI is, and that's because we have ebbs and flow in the economy. We have things that come along. For instance, like in 2018, we had tariffs concerns. Back in 2012, I think it was, we had hurricanes. 2017, we had Hurricane Harvey, right, and big devastation in Houston. Last year, just this past year, we had 2 massive hurricanes that just flooded North Carolina and Florida. So all those people had to go out, replace cars, replace couches and clothes and all these type of things. So when you have these knockoff events that occur, you're going to get these ebbs and flows and price pressures. Because again, what's inflation at the end of the day? It's not the deficit. It's not the debt. Anybody telling you that inflation has anything to do with the debt or deficit is a complete idiot. Because basic economics tells you that inflation is a function of supply and demand in the economy. That's it. So if I go out and buy stuff and there's a lot of buying that's going on, that's going to, and there's only a limited supply. And this is a great example of used cars. Right now, we're seeing used car prices, going up because there's, you can't manufacture a used car. There's only so many used cars on the planet. And so if everybody has to replace a used car from North Carolina and Florida, that's a massive demand on used cars that you can't increase more supply of. So if I own a used car, it's like, yeah, you want to buy it, you're going to have to pay me more for it because there's not a big inventory of it. You're going to see the same impact come out of California right now. So where you live, Adam, of course, they're talking about $250 billion worth of potential damage. You're going to have to replace houses and cars and apparel and appliances and all these things that were lost in the fires. That's going to create $250 billion worth of demand in the economy on things that have a limited supply. And so that's going to drive inflationary prices up in those areas. But those aren't big drivers of inflation. The big driver of inflation is homeowners equivalent rent. Rental prices as a function are still negative. So, that increase in home prices that we saw is continuing to come down. And over the last 2 months, if you take a look at the big driver of inflation, which is homeowners equivalent rent, that's been down 2 months in a row. So that impact of rental prices is still feeding through on the inflation front. So the point about all that is that we're going to have some ebbs and flows in CPI. We're going to get some bumps and wiggles along the way. But at the end of the day, it's all about economic growth, wages, and interest rates. And that's going to all pull back down towards the Fed's target of 2% over the next 2 years.
Okay, well, obviously we'll be keeping track of this. Bond yields, not for nothing, have been cooling off a little bit over the past couple of days, certainly since the CPI report came out. Some could say that's because of inflation expectations coming down maybe a little bit, but
well, see, that's actually a really interesting point, right? So there's a couple of things going on with the yields that have absolutely nothing to do with inflation or expectations. Because if you actually look at inflation expectations, whether it's the 1 year, the 5 year, the 10 year, they're all about 2.3, 2.4%. So your 10-year inflation expectations, that's it. Then that's what that's saying is like, what do I expect inflation to be 10 years from now, right? That's what that is. Okay, first of all, if you pull back up that chart of CPI, right? Anybody saying they thought inflation was going to be a lot higher 10 years ago had no idea, right? Trying to predict anything 10 years in the future is absolutely ridiculous. But we have, because it's just a question, right? It's me asking you, Adam, where do you think inflation will be in 5 years? So you say, I think it'll be 4%, right? So where's it going to be in 10 years? It's going to be 10%. Okay, whatever. But this is the survey. But if you take a look at inflation expectations across, so this is all done by the Cleveland Fed, right? They take these things and they run it out to 26 years. And there is no inflation. There has been no real movement in inflation expectations. Yes, it's bumped up a little bit here recently, but still very well anchored to its long-term inflation expectation of about 2.2, 2.3%, which is right where inflation has been on average for the last 25 years. So so inflation expectations doesn't explain what's going on with yields lately. Economics doesn't explain what's going on with yields lately. So here, you've got a good Stanford education. You paid for that high quality education. Let's see how good your math is here. Let's assume, just for a moment, so that we just have kind of easy numbers. I don't want to stress your mathematical capabilities too much. And
thank you
for that Stanford degree that you paid for. I went to a state college. But let's just say that economic growth is 2.5%. Interest rates are 2.5%, and wage growth is 2.5%. So what's the average of that?
Well, that one's pretty easy. It's 2.5%.
See, that Stanford education paid right off for you. Look how fast you got to that. So if those three things are 2.5%, and by the way, they're going to be lower than that, but we're just using easy numbers right now. Inflation will be 2.5% because inflation comes from those three factors. It's all about economic activity. So if inflation is a function of economic activity, which it is, then what explains the difference? So now let's just say that interest rates are 4% and we've got our average of economic activity at 2.5. What explains that difference between where yields are versus where they should be based on the underlying fundamental drivers of the economy, right? That extra 1.5%, where's that coming from? That's this mythical thing called term premium. And by the way, there is no such thing as term premium. You cannot calculate it. You cannot factor it. You cannot predict it. It is simply the differential. It's a plug. It's just for what if I can't explain why something is in interest rates is here versus where the economic fundamentals are, we just label it term premium. It's like people are just paying more for this than they should be because of economic activity. So we just plug this. It's how to plug a hole basically on things we can't factor in. So that's a term premium. It's complete nonsense. But what it is at the end of the day is just a measure of sentiment. And term premium and sentiment is a function of activity by Wall Street. So one of the interesting things that we talk about on Wall Street is bond vigilantes, right? It's like these bond vigilantes are going to come in and they're going to just rein in the government and all this. Well, vigilantism is supposed to be kind of a kind of like Paul Revere back in the day, riding through, and yelling, the redcoats are coming, the redcoats are coming, and he was the hero of the day. But in the bond market, these, what we label these bond vigilantes really aren't. They're actually predators. And these are just major Wall Street hedge funds and pension funds and short sellers that are just heavily shorting bonds in the near term. And that's what's creating that term premium between the economic fundamentals of the economy and where yields are currently trading. They're not doing a good favor to the markets because unlike stocks, which is always interesting, right? Because when we talk about the stock market, everybody goes, oh my gosh, valuations. Look how high valuations are. I'm so concerned about valuations. Well, what are valuations? Valuations are just sentiment. It's people overpaying for stocks versus their fundamentals, right? So we all stress out about valuations in the stock market, but it's okay, right? Because we're making money, because we're overpaying for stocks and they're going up. So as long as valuations are going up and sentiment gets better, we're all bullish. We don't worry about that. In the bond market, it's exactly the same way. So when there's a trade going on, which there is right now, which is I can short bonds and make money. And so if I'm shorting bonds and making money, then I'm going to short more bonds and make more money. I start driving yields up and bond prices down. But there's a consequence to this. Unlike the stock market, which affects really a very limited number of people in America, right? So we've talked about before, household equity ownership, 90% owned by the top 10% of the country. Bond markets affect everybody. So when these quote unquote heroic bond vigilantes, which are doing nothing to curb, the theory was bond vigilantes were going to curb government spending, that we're going to bring government to their heels. No, they're not. All they're doing is impacting mom and pop. They're driving your interest rate costs up, which affects everybody. It affects your credit card rates, your home loans, your costs for buying something, car, whether it's a house loan or car loan, whatever it is. All those rates are going up, and that's impacting the average consumer to Wall Street's benefit. So Wall Street's heavily shorting these bonds right now, creating this quote unquote term premium, which is simply just a trade to take advantage of a market. But ultimately, at the end of the day, bond prices are ultimately driven by what's happening in the economic fundamentals. So while the bond vigilantes right now are taking advantage of the average consumer, at some point they're going to hurt the consumer. And again, there's a big movement right now called the buy nothing movement. And I don't know if you've heard about this recently, Adam, but consumers are now pushing this whole new narrative of buy nothing. In other words, just buy the basic necessities, you barter for everything else. And if you can't barter for it, you either just don't get it or you buy it as cheaply as possible. That has a knockoff effect. If that catches on and everybody in America starts doing the buy nothing movement, what happens to economic growth and activity? Right?
That's what central planners fear, right? That's why they fear a depressionary mindset, right? Where people will continue to constrain their purchasing, and then you get this vicious cycle. Yeah.
Exactly. And then at that point, what happens to those poor and that's all going to be created by the bond vigilantes. And then at that point, if that takes hold, and you get much slower economic growth and you start pushing towards recession, well, then what happens to interest rates and inflation?
Hmm. Yeah, it's interesting. I totally understand the risk that you're talking of there. Part of me says American culture would probably be served by people being more judicious with their money and their spending and only buying essentials and not speculating or buying luxuries they don't need. But I guess I'll just say I'm not going to worry too much about this until we really see the retail sales numbers starting to drop.
If you just saw the retail sales numbers today that just came out this morning, retail sales came in at 0.4% lower than expectations. And remember, that was December. That was the Christmas shopping season.
Right.
Back out
And actually,
inflation.
Black Friday was in December in 2024 too. So it was a better December than there was more going on in December than normal, and yet it's
Yeah.
still disappointed a little bit. Yeah. I yeah.
Importantly, though, you back out the inflation of 0.4%, your retail sales were zero on a real
Zero.
basis.
Yeah.
So, consumers are getting impacted. We are seeing it, and I think we're going to see more of that this year, which is why, we talked about last week being a little bit more tactically bearish. This year, as we go forward, I would expect a lower rate of return. I think we're going to see slower economic growth, and I think this is all a function of what's going on right now.
All right. Well, like I said, let's keep our eye on it. But
Yeah.
until, because I was expecting consumer spending to weaken far sooner than it has. And so, again, I'm not going to start ringing warning bells on this until we start seeing real negative numbers, not just, flat real ones. Okay, let me ask a couple of basic questions here, partially on behalf of the viewers and partially on behalf of myself, still trying to wrap my brain around this stuff. So you talked about term premium, and as best I understand, term premium is really what you're paying for duration risk, right? So if I own a treasury bill with a normal yield curve, normally a regular yield, a non-inverted yield curve, which I guess we just call a regular yield curve, a short-term bill should have a lower yield on it than a longer-term bond. And the
Right.
reason for that is that the longer I hold it, the more interest rate risk there is over time, right?
Right. Just real quick,
Yeah.
all you're talking about there is basic fundamentals, right?
Yep.
So keep
Yeah,
going.
I'm just trying to make sure I understand the definitions
Yeah.
here, right?
Yeah.
And so what is the difference between the term premium and a credit spread? Now, I know credit spreads between two different types of instruments, like a high yield bond and a treasury. Okay, I get that. But there are all these curves we've been looking at. We've been saying the yield curve's inverted. Maybe those aren't credit spreads. Maybe those are just, when you're comparing the 230s or the,
That's
520s or whatever.
that's a yield spread.
It's
So
a yield spread, but it's not well, okay. But
uh,
is that any different? But is that any different than also is it
okay,
synonymous to say that's the term premium between those
no, no,
two
no, no.
treasuries?
Three different things you've got going on there. So
Okay.
if you're comparing two instruments of the same credit quality, so the 10-year Treasury and the 2-year Treasury, they're both AA rated, right? They're both
Yep.
government treasuries, so they're effectively just the same instrument. So all I'm doing there is I'm just comparing the spread, the differential between two different yields on the same instrument, right?
Yep. It's
So
basically the only difference is duration, right?
right. So
Yes.
I've got two Apple iPhone 16. One was $10. One was $1,000. That's my spread, right?
Yeah.
Uh, but when I talk about the differences between credit quality, right? So this is the important thing about bonds that is lost on most people because we just don't spend enough time educating people about fixed income. This is a big topic that Michael Lebowitz is covering today at the conference. And if you didn't come to the conference today, I hope to see you next year because it'll be well worth your time. But when you start talking about bonds themselves, bonds are very fundamental. They're very fundamentally driven. There are simply just, again, because when it's a bond, I'm loaning money, and we've explained this before, but I'm loaning money to somebody else. And I'm loaning it to them for a fixed rate. I'm saying, look, I'm going to loan you this money for 5%. Well, that 5% has to cover my risk of default, my risk of inflation, my risk of changes to interest rates, my risk of opportunity costs. all these potential risks, everything that could go wrong over a 10-year period, if I'm loaning money for 10 years, I can't change that interest rates. I can't call the borrower back up and say, yeah, interest rates went up. I'm going to change your. I can't do it. So I'm stuck with that rate for 10 years. So that I've got to be very fundamentally focused on making sure that I adjust and I account for all those risks going forward. It's not that way in the stock market. We just buy stuff because it's going up and down. We don't care the fundamentals too much. But when it comes to loaning money in the bond market, it's very sensitive to fundamentals. So now, to your point, we're now talking about different credit qualities. So now I'm loaning money to you, Adam, and I'm going to loan some money to my wife. Now, my wife is a guaranteed repayment. She is fundamentally structured. She is a frugal saver. I know that she will always pay back. She's a AAA credit. Adam,
I'm a deadbeat. Yeah, no, I admit it totally.
So I've got to take into that count. So if I'm going to loan money to Adam at 10%, right? Because he's no, wait, let me rephrase that. I'm sorry, I misstated. Say I'm going to loan money to Adam at 4%, right? Now he's got a lot of credit risk versus my wife, who I'll loan money to at 4%. And I know she's going to pay me back because it's my money she's paying me back with. So, but I'm taking a lot more risk with Adam. So that spread should be a lot wider because I'm not accounting for that fundamental risk that I'm doing there. So when you're comparing credit quality, that's a risk spread, right? I'm measuring different credit qualities, so that's a credit spread.
Yeah, so I get that, and it's important we keep talking about credit spreads, and we did talk a lot about them last time. Based on your example there, one of the issues with the market right now, the concerns that we have around the market here is that, credit spreads are generally an early warning system that the bond market's beginning to get concerned about something, right? And credit spreads are like the tightest they've practically ever been. And it basically just means, the bond market's not worried about risk. And so kind of a junky company, can borrow at pretty much the same rate as a stellar company, right? And, there are, pardon me?
And that shouldn't be the case, but it is.
And that shouldn't be the case, yeah. And I asked you last week, could the signals we're getting from credit spreads right now be a little broken? And we had a long discussion about that we don't have to come up with here. Let me just ask my question one more time because
I need to finish it. So the third thing you asked about was term premium, and term premium is just the difference that somebody's paying on a single instrument. So it's the difference between the fundamental rate and the actual rate people pay. So that's just on a single. You don't have term premium on a spread. You've only got term premium on a single instrument.
Okay. So again, this is maybe just me being dense, but let's take your first example of the only difference here is duration. It's a U.S. Treasury instrument. One is short duration, one's long duration. There's a yield spread between the two, right? But I thought that term premium was also the difference between what you have to pay on the shorter thing versus the longer thing when they're exactly the same other than duration. So to me, those sort of sound like the same thing. Are they the same thing or are they different?
Not really, because so the term premium, as an example, let's just talk about the 10-year treasury right now. So if I look at a 10-year or a 20-year treasury, whatever it is, the fundamental factors suggest that yield should be about 3.85% right now, not 4.7, or 4.8, which is where it was the other day. So that 1% differential between where it should be trading based on all the fundamental factors and where it is trading is the term premium. Again, that's the sentiment spread that people are paying. I am offering this out 1% above where I should be. That's the term premium. That's that mythical thing. That's that plug number that we just stick in there to account for sentiment.
Okay, so then how does that get calculated? Obviously, the sentiment price is just the market price, right? Who is calculating and tracking what it should be fundamentally price?
Well, that's where the bond market is, right? So that's your inflation expectations. That is your economic growth. That's all your other risks that you account for, right? So that's you can and Michael Leibowitz just built a model on this in earlier this week in an article he wrote on this discussing why yields are trading where they are. And he built this whole fundamental model that has about a 98% correlation to yields. And that's where you can come up doing the fundamental work. You find out that bonds should be trading about 3.85% versus 4.8. So that differential between where they're trading and where they should be trading, that's that sentiment, right? That's us overpaying for stocks, and that's why we have high valuations. That term premium is just that plug for sentiment in the bond market.
Okay. So I've seen a lot of articles recently, even a few charts showing that term premia are rising. Um, what exactly does that mean? And I know you talked a little bit earlier about, that's maybe due to the bond vigilantes and it's all, their efforts, their actions kind of hurt everybody because everything is priced off of these bonds. But like, why
There's
should we really care about an increasing or decreasing term premium?
Yeah, yeah, no, and so first of all, there is no such thing as bond vigilantes. It's a romantic term that gets thrown around. They've been claiming the bond vigilantes are coming since 1985 when I first started in this business, right? So it's just nothing more than again Wall Street pushing a trade. It's when markets are going down. If you remember back in 2008, we actually banned short selling for a while because short sellers were just crashing the markets every day. They were coming in, the markets were down because of what was going on in the subprime market. The short sellers were just jumping in on the markets and just shorting the market heavily, driving prices down even more. And so that was beginning to cause a lot of financial stress within the system. And so they banned short selling they just, you can't short sell now anymore. And, this is the problem with Wall Street is that when they smell a trade, they just all pile into it. And so now that works two ways. They pile into this trade and they heavily short it. That creates this suppression in bond prices, this increase in yields above where they should be trading economically, that term premium. But then eventually it has a negative ramification on the economy, and they've got to start reversing that trade. And then you get, like yesterday, you saw it, the biggest drop in yield since I think it was like 1993, which was just prior to the bond market crash in 1994. But they create systemic problems by doing this that has to then get reversed because they're heavily short. So when bonds go in the other direction, they've got to start buying bonds to cover all those shorts,
Yep.
and then, so that runs it up in the other direction. So that's this isn't a healthy. What's going on in the bond market right now in particular is not healthy, and it has very negative outcomes economically if it's sustained too long.
Okay. All right. So we should look at kind of, big moves in the risk premia, probably in either direction, more or less, as a sign that things are becoming a little bit more unstable because those extremes are going to have to revert in the way that you just mentioned, right?
Right, exactly.
Okay. So let's see here. I'm going to skip over a couple of the things that I have here. Let me just get to this. So while you and I are recording this, everybody else on Thoughtful Money is watching the interview that I just recorded with Darius Dale. And I just want to mention it here again, Lance, in case we want to revisit it at some point. Darius, as you know, has been quite bullish for the past 2 years. So like really in really early 2023, he went bullish. And when I interviewed him at the end of 2023 and congratulated him by saying, hey, you were one of the first people to go bullish when everybody was expecting a recession. We've had this great year that nobody expected. How are you feeling now? So this is November of 2023. He said, I'm the most bullish I've ever been in my career. And then we had another amazing year in 2024. So obviously you wanted to get a sense for how he was looking at the road ahead, what his model was telling him. And he basically said, well, I'm starting to slow my roll. He said, I would now call myself cautiously bullish here at the start of 2025. But he said, I fully expect to become a raging bear at some point this year because of valuation risks that he sees out there. And he basically thinks that the odds are better than not that the markets are going to hit some pretty decent air pocket, best guess around mid-ish year. One, by the way, that he said he would look to buy the dip of. He's not saying that's going to tip us into a multi-year bear market as best he can forecast right now. But I just thought it was very notable that one of the bigger bulls out there is now sending a much more cautionary note for 2025. And I think that's consistent with the guidance that your firm has announced, at the beginning of this year, saying, hey, we're just a lot more cautious this year than we've been, in recent years.
Yeah. And again, I agree. We got bullish back in October 22, and we've been bullish ever since. And again, we're now starting to become a little bit more cautious. I just wrote this article on Tuesday talking about tactically bearish as risks increase. And of course, immediately, as soon as you say that, people are like, oh my gosh, he's expecting a crash. And, that's not the case
Right.
at all.
Then the market goes up the next week and everybody says, Lance, you're totally wrong because we had 3 days of up markets. Yeah.
Exactly. And so, and here's the thing that investors always make the biggest mistake on, and we saw this a lot over the last couple of years. People was like, I think the market's going to crash and I'm going to lose 50% of my money. So I'm just going to be in bonds or T-bills. I'm just T-bill and chill, let the market crash. Then I'll go buy stocks. And now, 60% later, here we are. The important thing is bear markets rarely happen all at once. You have plenty of lead time to understand when the markets are going to eventually take a turn. And so I built this chart for the article, but this is basically just the S&P index going back to 1995 versus the 48-week moving average. That's a 4-year moving average. Now, there's nothing special about that. It's just that the 48-week moving average has been a very good trend of the overall market. So if you look back in 1995 through 2000, it just kind of bounced off that orange line all the way up to the peak. Finally crossed it in early 2000, and then you were below that trend, and then that trend line, that moving average, became resistance all the way down during the correction. Got back above it in 2003. Stayed above it, trended right along it until 2007. You kind of broke through it in 2008. It became resistance all the way through 2008, and then so forth and so on. So you can see, though, that over time, just following that kind of moving average kind of gives you a good indication of when to get in the markets and be bullish and when to tailor your risk. And right now, there's no reason to be bearish. The problem we have currently is that we're very deviated above that 48-week moving average, and moving averages over time, as we talked about before, kind of act like gravity, and they're eventually going to pull the markets back down to it. And you can see this historically. That's the case, is that historically you regularly touch that moving average, over the last, kind of 30 years. So again, at some point, we're going to come back down and touch that 48-week moving average, and as long as we don't break below it, that's great. That'll be a dip I can buy, and we'll get super aggressive. And at that point, keep going, kind of keep going down the road. But if we break below it, that's going to be your indication that now we've got a bigger correction coming. But again, the important thing is that I'm going to have plenty of lead time before I even get to that point of a market starting to correct to reduce my exposure, hedge risk, do those type of things. And so people are kind of waiting around for this. Oh my gosh, I'm not going to do anything because I think the market's going to fall by 50%. It won't happen in a day. It'll happen over the course of a year or 18 months. And you're going to have plenty of time to kind of work your portfolio into a more conservative position. But we can certainly participate in the markets while it's in its bullish process. And this goes back to, we were talking about credit spreads earlier, but credit spreads currently great leading indicator of bigger market corrections. They will turn up ahead of a correction in the markets. Right now, there's no evidence that we're ending this current bull market or anything else. So it's just something worth paying attention to. Valuations, I agree with Darius on this. Valuations are concerned. Valuations are sentiment. In the short term, valuations are all about sentiment. And right now, people are paying more for stocks, creating valuation levels that are well above the trend of growth in the economy. And if you look back over history, it's bumpy, but there's a decent correlation between the trend of economic growth and valuations. And right now, valuations are detached from economic growth because economic growth is where earnings come from. And so right now, all the analysts are super bullish. We're going to have like a 15% increase in earnings this year. I think it's going to be closer to 6 to 8 by the time we get to the end of this year, because that's what the economy can actually kind of generate. So, and again, we were talking about inflation and interest rates. This is the model I was talking about that Michael Leibowitz built. So this is the Cleveland Inflation Index and GDP model, which is has an extremely high correlation. You see on the right, 4.88% was when he wrote this article. That's where the Treasury rate was. 3.78 was where the model should be. So this gap, which rarely exists in historically, going back to 1990, that gap, that's that term premium.
That's the term premium.
That's the sentiment, right? Spread between what the markets are thinking versus what economics are telling you and what the markets are expecting. So that, and again, that this has an extreme. So this is, so to your point, this is exactly where we are. So this orange dot is the term premium where we are right now. 2018, 2019. So a lot of this term premium right now is fear over tariffs, right? So the bond market's selling off bonds, expecting this, this massive increase in inflation due to tariffs. But 2018, 2019, there was no inflation from tariffs. This is when we had tariffs going on under the Trump administration the first time, actually trading at a term discount most of the time. So again, this kind of irrational exuberance right now and what's going on over inflation isn't likely going to exist for very long. But the problem with this is that higher sustained rates impact earnings. And when you have an increase in rates, which you have going on right now, you are going to negatively impact earnings. And back to your Stanford education there, Adam, what happens with higher interest rates when you start talking about weighted average cost of capital, investments into long-term projects, those type of things? What do corporations tend to do when their borrowing costs exceed the return on investment that they're going to get out of those projects?
Well, they just start to do fewer projects.
Right, which impacts economic growth, and that slows earnings. So all this, so these are all reasons why we're coming a lot more cautious this year, because we're now starting to stack up all these variables that are about to start impacting earnings. And we're going to have, and again, depending on policies from the Trump administration, if he starts slashing spending in government, that's a drag on economic growth, that's a drag on wages. So there's a lot of things coming potentially that are going to weigh on economic growth. And already we're seeing we talked about credit spreads. Those aren't reflecting yet in the number of bankruptcies that we're seeing across the corporate market. So again, the market's kind of, the bond market's kind of really detached from what's happening. But again, the biggest driver, and again, back to what Darius Dell is saying, and our biggest concern is that rising interest rates will impact valuations. It has historically, repeatedly. Doesn't mean you're going to have a crash, does not mean that at all. But you're going to have a valuation reversion at some point, because markets are going to have to start reflecting higher yields in their valuation calculations.
Yeah, and this is, a manifestation of the lag effect, right? We talk about how, whether it's policy, the Fed hiking interest rates, or whether it's markets, where the bond vigilantes, or whatever you want to call them, Lance, or the bond market is driving yields higher for longer, acts as like additional gravity on economic growth. It pulls it down more, and given enough time, given higher for longer enough, it's going to start cooling things off in the economy.
Yeah. And and again, we run a risk model. And again, Darius runs his models. We run our models. Kind of everybody has a different way of kind of getting to.
And to be clear, you guys don't agree on everything either, and I'm not going to bring up the other stuff. But everybody, and just want to reiterate, this is one of those periods where really smart people are looking at the same data and coming to different conclusions, which makes it interesting, but also kind of confusing as an investor too.
Yeah, absolutely. But
that's what makes a market.
Absolutely, that's what makes a market. But this is a model we've used for years to navigate markets, and kind of that gray shaded background is our risk exposure. So when markets have triggered signals, that's where we've increased or reduced risk, relative to the markets in our portfolios. And you can see back in October 22, where markets were bottoming, we got signals. That's where we increased risk back to, full weighting. We're still there now, but we're now back to the upper end of that long-term bullish trend channel. All of our indicators are now at peaks that we only saw, actually have exceeded peaks that we saw back in 2020 when we were just flooding the economy with stimulus checks. So we've had all this exuberance in the markets, and we've now driven markets to deviations above long-term means that are very hard to sustain longer. So this is another reason why we're expecting, either a correction of some sort this year. Could be 10, could be 20% to reverse some of this, and get markets back into a more sustainable footing.
So we're going to get to your trades obviously here, and trades are short term, but with that forecast, right? Hey, we think a 10 to 20%. I mean, a 20% correction is not nothing, right?
Right. But again, it won't happen overnight. It'll happen
Yep.
over a period of a few months.
Right.
So we'll have
Right.
plenty of time to realize that we're getting into that position. So you shouldn't panic over that and go sell everything today to try to avoid a minor correction.
Great. And that's the spirit of my question. So you shouldn't panic, but are you taking we're not going to worry about it until we start seeing signs X, Y, or Z, or are you actually taking some precautionary steps now? It doesn't look like you've reduced your percent equity exposure based on that chart. It looks like it's still.
No. Well, we haven't. So in that chart, right, we have triggers that, and you'll notice they're big drops, right?
Yep.
It's fairly substantial drops. So we have triggers. When we get certain triggers, that's where we reduce our, just for sake of argument, let's say it's 100% equity portfolio. The first trigger reduces portfolios by 25%. The second trigger reduces it by another 25, so they are at 50% exposure. The third trigger reduces it by another 25, so now you only have 25% exposure. We never go below 25% exposure in the model. Now we can short against that, we can hedge it, but you never want to be out of the market entirely, because when the market bottoms, it's going to be when you don't want to buy it. But if you already have some exposure in there, when markets start to recover, it makes it easier psychologically to start adding to those positions and getting back in the markets. Going from zero to something is the challenge that most investors can't get over. So we'll reduce that. We can actually go to zero exposure by hedging, but we never get out of the market entirely. So that's those big jumps. But no, before we get to those big jumps, we're already taking action. In fact, just on Tuesday, ahead of the CPI report, we actually took some action in the portfolio. We reduced our overall equity allocation by about 1.5%, not a lot, but ahead of that CPI report, because we didn't know exactly what was going to happen. But we've had big gains in stocks like JP Morgan. We trimmed that back to target weight. It gotten over target. So we reduced that back to target. In fact, tomorrow, we talked about this last year, about once a year, I produce this article. It'll be on our Substack. So if you go follow me on Substack at Lance Roberts, our article on gardening and how it applies to your portfolio will be out tomorrow. And those rules of gardening apply very much to managing a portfolio. So yesterday we were harvesting some bounty and planting a couple of new seeds. So Palantir, as example, as a company we wanted to buy for a while. It's had about 22% correction. So we planted a little seed in Palantir. We'll see how it works out. If it starts doing well, we'll add to it. We owned NVIDIA and AMD. We trimmed NVIDIA, which has been doing well for us, and we added a little bit back to AMD, just bringing AMD back up to target and reducing NVIDIA to target weight. We also went through and trimmed a couple other positions in the portfolio, again, just kind of moving them back to target. One of the things that we had done a couple of months ago, Adam, you and I were talking about oil prices had gotten extremely oversold. Mm-hmm. We were expecting a rally in energy stocks, so we'd added ExxonMobil and Diamondback Energy. Those have had nice returns. Market's been going up with oil prices. Oil prices are now very overbought. We're probably at the peak of this move in oil prices. So we went and took profits in Diamondback Energy. It had a very big advance. So we just took some profits back in. So overall, on between the buys and the sells, we reduced overall equity rating by about 1.5%.
Okay. All right. So, well, we just ticked off the trades there. We're going to do it in reverse this week. Can you pull up the S&P now and just give us, your latest TA readings on what it's telling us?
Sure. It was actually kind of interesting. Here, let me get to my share. 1 second. It was actually kind of interesting because on Monday, let's see when it was. This is Thursday. Yeah. So on Monday, the market had broken below the 100-day moving average, and I published this chart in our daily commentary, and I said, here's where we are with this channel. We're just breaking to the bottom side of this channel, and we broke the 100-day moving average. So it's going to be very important that we recover back above this, and the markets are oversold enough, and we're very close to the point of triggering a buy signal, and money flows are turning positive. So I kind of drew out this pathway of what I thought would happen with stocks this week, and so this is this green shaded area in the background. And I was talking about money flows earlier. This green shaded area in the background is money flows. It's the money flow index. And, as we saw back in early December, where we started talking about mutual fund distributions and the end of the share buybacks and why we could have some weakness, money flows started to decline. And then money flows went negative as we got further into December and remained negative through early January. And then over the last few days, even though the market was selling off and everybody was kind of panicking over the CPI number, two things were going on in the markets that anybody running headlines out there going, oh my gosh, the market's selling off because of inflation headlines. It really wasn't. Money flows were turning positive. Money was coming into the market. Even though the price of the market was declining, buyers were stepping into the market, starting to buy into the markets. And then on Monday, the market broke below the 100-day moving average and then rallied all the way back up above it by the end of the close on Monday. Money flows increasing. On Tuesday, the market opened below the 100-day moving average again, rallied back above it, closed above it on Tuesday. And then on Wednesday, we got the CPI report, and buyers were just all in at that point. But the 2 days prior to CPI, where everybody, I don't want to do anything ahead of CPI because I don't know what it's going to say. The market was telling you the number was going to be benign, and they were buying the market ahead of that run. And so you saw money flows coming in. And so this dotted line, I just drew this dotted line. I said, this is where I think the market's going to take us. If we have a inline or better PPI CPI report, the market's going to rally back to the top of this downtrend channel, which is exactly where we are now. We have two ways to go from here. Either the market's going to come back down and retest this 100-day moving average, or we're going to break above this trend line and make a move back up towards 6,100. That's what we're wrestling with today. Today, on Thursday, the market's wrestling with the 50-day moving average and this good bit of resistance between the 50-day moving average and this downtrend line. If today or tomorrow, on Friday, if we can break above that downtrend, we're going to have a good run back to basically towards all-time highs. We'll see what happens. But, technically, we're very oversold. We're about to trigger a buy signal from a deeply oversold level. So there's a good bit of buying potential. If this MACD turns positive in the next day or so, that's going to help support a further rally in the markets over the next 2 weeks. And that's why we kind of added a little bit to positions that we think will participate if we get a further rally.
All right. So on this chart, there's that straight light blue line. That's
Right.
the trend line since August, right? And you noted for us the other week when the markets initially broke below that and said, yeah, that could be material.
Yep.
We're pretty much still right at that line right now. If the market decisively closes above here, moves above here, are you going to put more capital to work because you think now it's kind of an off to the races moment?
Well, no. Well, right now we were overweight equity. We were about 63% equity. We're now about 60.5% equity. So our target weight in our 60/40 portfolio is 60%.
Is 60, yeah.
Right. So we're still fully allocated to equities, but we've reduced our overweight to equities a smidge, and we'll see what happens here. But no, I'm not going to get aggressively long the market. I think this market can rally back up to 6,100-ish, and we're going to start to struggle in here somewhere. And again, my outlook for this year is that we're going to kind of see a year where returns will be lower, more of this kind of sell-off rally, sell-off rally, sell-off rally type situation kind of all year long. And I think that's going to, potentially kind of weigh on investors in a lot of ways psychologically, because it's like, man, this market's just kind of all over the place. One of the big drivers over the next 2 weeks is going to be earnings. So, a lot of this market's going to depend on Apple, Microsoft, Google, these companies as they announce earnings. That's going to be a big driver for the markets.
All right. And folks, obviously, we'll be talking about those earnings when they come out here over the next couple of weeks on the program. Real quick, one sector we don't talk that much about is the banking sector on this program. The banks just released their earnings, good earnings. The banks actually seem to be doing pretty well these days. When you look at bank profits and you look at their share performance and stuff. Um, so, 2 years ago, everybody was all of a sudden worried about the banking system melting down now, fully rescued and, versus other sectors going forward. What do you think of the banking sector's prospects?
Well, interestingly enough, so we bought some, right after Silicon Valley Bank crisis, we bought um, companies like PNC Bank and Truist Financial because they were getting beaten up with the over the Silicon Valley Bank concerns. We still own Truist right now in our dividend model, but there's some risk to those mid-sized banks. So again, the differential between the banking sector is the J.P. Morgans, Goldman Sachs of the world and every other bank because JP Morgan, Goldman Sachs, they are so large, Bank of America, Wells Fargo, they're so large that, and they also have, bank prop trading desks. They can take advantage of financial markets. They're doing investment banking. They're in so many different things that have really nothing to do with banking. Since we put banking and brokerage firms back together back at, kind of at the turn of the century, we put those banks and brokerage firms back together. So there's a lot of support. Those banks have a lot of revenue support from areas other than just banking, right? When it comes to the average regional bank, the Truists, the PNCs of the world, your Regions Bank shares, these type of banks, they're pretty much, down to making loans to mom and pop businesses and car loans and mortgages and those type of things. So their business revenue lines are much different. And so we're going to be watching very closely to see in over the next 2 weeks, we're going to have really, starting today and tomorrow and the next week, lots of regional banks reporting. And I'm very interested to see how these higher rates, and remember, this is how we got in trouble back with Silicon Valley Bank, is rates went up and it impaired their collateral values. And the FDIC stepped in and says, you don't have enough collateral, you got to shut you down. So that's going to be an interesting thing to watch with some of these regional banks is if these higher rates are impairing their ability, their collateral values more than anything else. And also looking at some of their discussions about net interest income and those type of things. One thing that JP Morgan noted is JP Morgan says, yeah, our net interest income is looking great. Well, yeah, it should be. Interest rates are at almost nearly 5%, and you pay zero on money market balances. So, yeah, your net interest income should be doing great. But again, they can get away with that, but a regional bank can't. And so I think the reports from the regional banks will be very interesting over the next few days.
Yeah, well, also too, just, not for nothing, regional banks is where the majority of the commercial real estate loans are held. And I'm sure higher yields are not helping that existing dumpster fire.
Right. Well, and again, like I told you before, is that those banks have been very quietly getting a lot of that exposure off their books. So that'll be another interesting thing to see is how much of that collateral do they still distress collateral do they still actually have on their books?
Right, right, right.
And how
All
much
right.
did they sold off to BlackRock? So,
Pardon me?
and how much did they actually sold off to BlackRock, which now owns it
Yeah.
also?
Yeah. All right. Well, look, we got to start winding up here, Lance. This week's will be a little smidge shorter than normal. But if we can, let's go to lightning round real quick. So, just curious your thoughts on the impact these may have on markets / the economy. We just got the announcement yesterday that it does look like a peace deal has been struck between Israel and Hamas. If indeed more peaceful days are coming to the Middle East, how big of a development is this looking through the lens of the economy in the U.S. markets?
Zero. We're always concerned about those geopolitical events. Those are sentiment events. They have very little impact, except for the defense sector, right? So the defense sector benefits from global outbreaks, et cetera, because we sell weapons to them. So it could have if there is a peace deal there, that's great, right? I mean, I'm all for that, and that would be a fantastic
great for humanity.
deal.
Yep,
Absolutely great for humanity. Not so great for the defense sector. Probably makes no difference to the markets.
Okay. Let me just add on to that. I'd expected that to be your answer, by the way. But let me add on to that. Let's say Trump is successful in his first 100 days in bringing about a conclusion to the Russia-Ukraine war. I don't want to say whether that's comment on how likely that is, but it's a claim he's made. Let's just say he's successful on that. Suddenly we have peace in the Middle East and in Russia, Ukraine. Same answer, or is this beginning to become something that has a more material and hopefully positive effect on the global economy?
Well, I think it has I think it will have a great it'll be a great mental relief. Certainly could help the European economy. Again, one of the things that Germany is struggling with right now is trying to get gas for energy, right? And Ukraine is basically shut off. The Russians have shut off the gas distributions, et cetera. So if they can get all that stuff opened back up, get the Ukraine situation resolved, and kind of get gas deliveries back open to Europe, that'll certainly help their economy. Their economy is on the verge of recession, kind of over there as well. So it'll certainly be very good for the European economy. That could potentially, help us a bit from, maybe, getting a little bit stronger economy there. They buy more exports from us. That could be good. But net effect, the one thing is we won't be sending $150 billion of taxpayer money over there. So that's $150 billion worth of taxpayer savings potentially. Could impact the defense sector because, again, a lot of that money we sent over got turned around, wind up buying weapons from Raytheon, Lockheed Martin, et cetera. So it could impact the defense sector. We have one defense stock in our portfolio. We've owned Raytheon for a very, very long time. We just recently reduced that a couple of months ago. But again, we're still kind of along that position because one thing that Trump does talk about is peace through strength, and he does want to increase military spending. Raytheon would benefit from that. So it may be a little bit of an offset. We'll see what happens. But, just in terms of a big boost to the economy, I think it'll be more of a mental relief, and I think people will be very, very happy about it. Good for humanity.
Okay. Interesting about your point of, we wouldn't be sending the billions over to Ukraine in war aid. There probably likely would be a lot of U.S. corporations there helping in the rebuilding of Ukraine, which obviously would be sorely needed. A lot of people would say, hey, that's the, mercantilist, U.S. breaking things and then benefiting from the repair. But
don't worry about that. BlackRock has been building private equity funds for the last 2 years for the rebuilding of Ukraine. So they are already well ahead of you. I think they've already raised $500 billion for the rebuilding of Ukraine. They're going to make a ton of money off this.
All right. Oh, okay. All right.
Surprise.
All right. The LA fires. So the latest estimates I've seen for losses, and of course, there's still literally a lot of smoke in the air. But best estimates right now are perhaps $250 billion or maybe even more. And from an insured loss standpoint, it looks like less than half of those losses are insured. Obviously, this is going to have some pretty big repercussions for the state of California. But is it big enough to have an impact on the overall U.S. economy?
Well, just put it in perspective, right? So let's just say, for instance, that tomorrow they could drop a check for $250 billion into the economy. Well, the economy grew, economic growth is right around 27 trillion. So, I mean, it's certainly going to help. And again, this is what I was saying earlier about North Carolina and Florida, right? So all these people had to go out and they had to buy apparel, they had to buy cars, they had to replace everything. But this is the broken window fallacy, right? That you and I've discussed before. All I'm doing is replacing lost goods. I'm not investing this capital into new economic growth. So yes, we're going to get a short-term economic bump out of this. Yes, we're going to see prices on certain things, kind of increase some. But a lot of this will depend on how fast it comes back into the economy. One of the problems that California has is all these regulations. So potentially, if I want to build a house, it may take me a year to get a permit to rebuild a house. And considering all the people that are going to try to get permits to rebuild their homes, this could take a very, very long time and kind of filter slowly into the economy over time. So the net impact of that 250 billion won't be kind of a big surge all at once. Potentially, it may be so spread out that the net impact to the economy is going to be slower than what it would be, for instance, in North Carolina or Florida, where people went out immediately and had to buy a car, right? So we'll see what happens. But yes, there will be an economic boost from this. But again, relative to the size of the economy, it's not going to move the needle substantially. It's not going to create 4% economic growth, replacing these houses. And again, the other side of this is that I'm replacing things. So in other words, I'm dragging forward future consumption. So I may get a bump now from this activity, but then the consequence of that is the loss of purchasing in the future because I've pulled forward all those future purchases. I was going to replace my couch that I hated in my house, but now I've got to do it now rather than a year from now. Or the car I had, I was going to buy a new one in 3 years, but I'm going to have to buy it now. So we drag forward that consumption, so that kind of leaves a void in the future. One of the interesting things I'm really kind of waiting on to see for California is right after we had Hurricane Harvey in Houston, and we had flooding in areas that hadn't flooded like in 500 years. Well, now if you build a house in those areas, you can't get flood insurance. It'll be very interesting to see now if the insurance companies come in and say, "Great, you want to rebuild there? That's awesome, but I'm not giving you fire coverage for it for next time."
Right. Or I am at 5x what
Yeah,
the price was
yeah,
before.
you want it's going to be super expensive. So, but this could change a lot about, and I'm interested to see is like how many people go, I'm just not going to rebuild. I'm just going to move somewhere else and build somewhere cheaper. So I'm just
I think you I think
tired
I
of the
think you're going to see
fires and
it.
tired of all the other nonsense.
Yeah, I think you're going to see a ton of that. In many ways, I think it might be just because they're going to be forced to. Like they literally won't be able to afford to rebuild at the new prices that are likely going to be there. And I know a little bit about this because I live in Northern California, and several years ago we had a number of years where we had major fires around here. I've been evacuated, on several of those years. And to your point, Lance, it took way longer than people initially thought to rebuild their homes in these places for a whole variety of reasons. Definitely permitting and all that type of stuff, and trying to get checks from the insurance companies, to then rebuild. But another one was just logistical. Was like the contractors around here were booked out for years.
Yeah.
Right. So there just literally weren't enough people here to rebuild. And there are also things like, you have a neighborhood that burns down in an inferno, the infrastructure gets destroyed. So before you can even build your house, you have to wait for them to come back in and tear out the melted gas lines and reinstall them. And there's just an awful lot that has to go on there. So I should have
That's not,
also noted, sorry?
yeah, that's what I'm saying. This could be spread out over such a long period. It's a negligible impact. Right.
Got
And
it.
again, I don't know the answer to this. I'm just, trying to look historically at what happened with hurricanes and other stuff we've had. And this is different. And again, to your point, it could just be very spread out over a very long period of time.
Yeah, well, okay, so I agree with that. And I should also add in too that I think in terms of, I think, fires in the US, this is like by leaps and bounds the most expensive we've had in terms of damage. In terms of natural disasters, I think it's right there with what was number one right before this, which was Hurricane Helene, right, which just happened a few months ago, right? So we've had two of the most expensive natural disasters kind of back to back. If I add that up, that's actually over half trillion or more in damages. And yes, there'll be a lot of spending as the rebuilding goes on. But like you, I don't like this broken window fallacy because you are replacing something. You're not getting a net incremental benefit from all this spending. You're just simply replacing an asset that was there before, right? So I'm actually more concerned in the near term of the impact on productivity and consumption by people that were fine financially, but all of a sudden have now lost their house, have all the uncertainty about rebuilding in LA. I don't know exactly what the case was more like, back on the East Coast with Helene, but like a lot of the homes down there were bought like in the 70s, and for a fraction of today's market prices, and in many cases those homes had long been paid off. And as the cost to insure kept going up, a lot of people were like, I mean, I'm sitting essentially on a free house here that to pay these kind of rapacious fire insurance premiums, I'm just going to self-insure, right? Which is one of the reasons why majority of the damage, the structures that burned, it appears are not insured, right? So you're going to have a lot of people whose financial prospects are getting severely impaired as a result of this. So I do
Yeah.
worry about that.
Yeah, there was a great article about this yesterday. Is that there was a lot of people. You look like the average net worth of Californians, right? It was like 1.3 million. It was all in their house
Oh,
because, to your
yeah.
point, they bought a house for like 300,000. They paid it off. Now the house is worth 1.8 million, and they didn't really have any other savings. And so there's kind of this distorted view of the net worth of Californians because it's all tied up in their real estate. And now and I heard a rumor, and I have not verified this yet. So you know
Grain of salt. Yep.
so just take it with a grain of salt. But that Gavin Newsom was basically putting out an edict that people could not come in, and he was calling it predatory purchasing. Couldn't come in and say, "Hey, I'm going to offer you a price for basically your lot. Your house
Hmm.
burned down. We're going to give you, your house was worth 1.8 million. I'm going to offer you a million for the lot." And he's saying, "Oh, that's not fair. That's predatory. You're taking advantage of people." Well, that's kind of the market, right? And a transaction is built between a buyer and a seller. So if I'm a guy or if I'm a person that I put $300,000 in a house and that was 20 years ago, and the house burned down and somebody offers me a million for my lot, why wouldn't I take that if I wanted to move somewhere else and rebuild somewhere else, right? I could move to Florida or Texas, Illinois, wherever. But he's potentially standing in the way of allowing, individuals to construct a contract to potentially, let them have options to do something else. And look, I'm not criticizing Gavin Newsom. I certainly understand this. He doesn't want people to get taken advantage of, but at the same time, you've got to have the ability for investors to come in and negotiate contracts with individuals that may want to have a different option than just rebuilding their house.
Yeah, I don't know. And as we talked about the other week, there is so much anger and a lot of justified sort of finger pointing on why things were so vulnerable down there, that I do think we're going to potentially see a lot more change coming out of this in California that I think folks could have imagined prior to the fires. On the political side and on the municipal side and probably from a whole host of areas. I haven't heard that rumor, so I can't comment on whether it's true or not, and I don't know the details, so I can't really say much intelligent about it, except to say, part of me agrees with you, Lance. Part of me, though, if it's the black stones of the world coming in and basically buying up, whole neighborhoods, you can make the short-term argument that yes, they're giving money to people that are in financial need. But then, are they potentially sort of changing residential neighborhoods into, a permanent buy to rent, corporate landlord owned, uh, municipality going forward? And we've talked back and forth about some of the pros and some of the cons of this increase in institutional ownership. I don't know what's going on there, but I would have that worry.
Yeah. I just pulled up. I was just while you were talking, I just searched real quick. This was the kind of the order from Governor Gavin Newsom's office talking about protecting fire victims from predatory real estate speculators. So, again, when you start impact, again, for me, I'm very much a free market guy. I think you should let the markets work, and they tend to work best if you leave them alone. Are there predatory, people out there? Absolutely. There's always those people, and you do have to protect people from them. But at the same time, I think when you start trying to just, you know, do a blanket order like this that impacts the ability of the free market to operate, that tends to hurt people more than it helps them.
Yeah, and I can't disagree with that. I can't
Yeah.
disagree with that. I do just want to go on record, though, that I do worry about the potential for this movement we've already seen over the past decade plus of increased institutional ownership in the residential
Oh, yeah.
markets. Um, those are the guys who've got, a lot of dry powder here to step in and say, yeah, I'd love to be the new owner of Pacific Palisades. I'm just not sure that's great
I'll
you
just
know,
buy Southern California.
yeah,
So
exactly. I mean, the problem is we have funds now that pretty much could. I mean, BlackRock could just say, all right, let's create a competing fund to the Ukraine one to own as much of LA as we now can, right?
you need 250 billion to rebuild it. Here's 500 billion. We'll just buy the whole thing, right?
Yeah, exactly.
Turn
So,
it into a
okay.
giant resort. So yeah, no, look, I don't disagree with you. I've talked, we've talked before about, corporate institutional ownership of homes, and again, it's a slippery slope at the same time. Corporate corporations that manage rental properties and all that, they do provide a benefit, but it can go to, as with all things, it can go too far, and we do need some guardrails around this too, so that we don't restrict individuals from the ability to be able to own a home.
Yep. And I don't have the clear answer on this, so happy to hear folks' ideas in the comments. All right. Well, look, I think we got a little bit of time to do a quick ending here. Uh, so we talked a bit last week about uh, the importance of how to use your time, right? I put that little matrix up, right, and where we should be focusing our efforts. And that proved to be pretty relevant because just last night I got some good news about a project I've been working on for a long time, like well over a year. And finally got the news that I was hoping for on it. And it was one of these things that was a total marathon, right? If when I started it, I was like, this is going to be a lot of work over a long period of time. Uh, but I knew that if I didn't start it, I'd never accomplish the goal. And look, along the way, there were frustrating times where it wasn't moving as fast as I wanted, or the ball was in somebody else's court, and I just had to sit on my hands and wait. And so I wouldn't say it was all sunshine and roses, but definitely now that I got the news I was hoping for, totally worth it, right? And where I'm going with this is, I think we often underestimate the value of time and what an amazing asset it is, right? Um, and certainly you talk to somebody who's at the end of their lifespan, and they're going to tell you very truly it's the most important thing in the world. Lance raises his hands. Um, but the message I want to kind of deliver today is, um, you can use it greatly to your advantage, and you don't necessarily have to uh, expend it. If you want to accomplish something, you do one of two things. You can do a whole lot of work immediately to try to get the goal right away, or you can do just a little work consistently and leverage time in your favor, right, to accomplish the same amount of work at the end of the project. And so, I think about the physics equation for work. Work is power times time, right? So you can either have a lot of power up front and require a little bit of time, or if you've got a lot of time, you can just have a little power and just, apply that over time. And a great example of this is the movie The Shawshank Redemption, right? The main character, Andy Dufresne, he had just a little bit of power, right? He had the will, he had the courage, he had the plan, and he had a spoon, or what was it? No, it was a little rock hammer. That's what it
Okay.
was, like a tiny little rock hammer, right? But he had a ton of time, right? And he was able just to take a little bit of power every day, just chipping away at that cell wall to eventually dig the tunnel that would enable them to escape the prison, right? And so, I think about the ways in which I in my life try to use the time that I have to say, look, I've got a goal, I got a lot of things I'm trying to do, but if I just be consistent, towards that goal over time, I don't need to have a lot of effort. I don't need to spend a lot of time on it every day. If I've got enough time to be able to say, look, if I want to have this thing done in a year or 2 years or 6 months or whatever, I can use time to my advantage to just do a little bit every day, right? And you and I have talked about our fitness regimes, right? I've been doing this strength training program. From week to week, I don't see that much difference at all. But when I look at when I started 7 months ago to where I am right now, the numbers have really moved, right? And I've just been using incrementally a little bit of time every week, and it eventually compounds and pays off. In fact, I was just talking to a guy yesterday, a friend who was commenting, I was talking to him because he lives down in LA and evacuated, but fortunately his place is okay. But we have kids of college age, And he was telling me that he's like, yeah, I feel badly for a lot of my friends here because many of them lost houses, but specific to our kids in college, a lot of them have been complaining even before the homes that like, paying for college is it's a real stretch for them. Where he said, fortunately, I just started contributing to a 529 plan when my son was really young, and now, it's kind of a non-issue for us. We have enough for his tuition, and probably going to end up having some left over after he's graduated. And of course, then I didn't talk to him about the fact that they've changed the rules, and if you have any excess 529 money, you can now roll it into a Roth going forward. He was like, wow, that's great news. But the point there is he just, rather than having to say, okay, I'm going to wait until my kid's going to college and have to come up with this massive amount of scratch, he just did the little drip over time, right? And let time work for him. In fact, this is what I do with thoughtful money when I am trying to get new, bigger names on the program. Coming up with Richard Koo, we've got Nouriel Rubini, we've got Jeffrey Sachs. These are kind of big names. They take a long time to go after. I just send out what I call like time arrows. I just send out arrows to all these different people that I would like to interview. A lot of them I don't hear back from. I reach out to them again. It might take me a month. It might take me 6 months. I have some it's taken me over a year. Rubini is a great example of that. I've been trying to get him for probably 2.5 years, right? But just that chipping away over time, eventually you're going to start having hits. And as you get, some of these big names, it then gets easier to get another big name because that big name joined you, right? So these are all examples about how, we should be looking at time as this great advantage we have. And so I guess, to kind of wrap this up, a lot of people, they think of a big goal and they just think, oh, that's going to take a ton of effort. I can't do it, right? If you can ask yourself, well, wait a minute, what's my duration that I'm willing to wait to have this payoff? Is that enough time to actually break this up and do a lot of little steps so that it's not that hard for me? I don't have to exert that much energy in any given cycle. But if I just remain consistent at this, I can, have the benefit of finally achieving one of these really big goals in my life, if I'm just patient enough to let time do the work for me. So anyways, Lance, I'm sure you've got thoughts on this. I mean, you're in the business of compounding, right? So the sooner people put money to work, the bigger the impact it's going to have down the road. But I'm sure you've got some of your examples about the power of using time to your advantage here.
Well, no, it's just, it's like everything, whether you're trying to build a project or, build a business or whatever it is, it's just, it's the old saying, how do you eat an elephant? One bite at a time.
Yeah.
And that just goes, true to form to this. I told you earlier that I had lunch with my mentor yesterday, and we were talking about, employees and training employees and, making sure employees are cohesive within a business. And, a big part of that is a function of time. And you have to build that by giving them input into the business and letting them voice their opinions, let them voice their concerns, whatever it is, but then take that information and then actually let them see visual changes within the business because of their idea or their input, and that
Hmm.
builds a much more cohesive structure for the business so it can grow. And the same thing that we do in our business. We allow all of our advisors, we have meetings 3 times a week. We allow all of our advisors to put their input into our portfolio management. Some of it we don't do, some of it we do, but they have input. They know they've got skin in the game, so to speak, and it creates a much more cohesive unit. But that takes a long time for that to really, you just don't do that and then tomorrow, you have these, results in your business. So if you're trying to grow a business, it's very small changes that require a lot of time. That as long as you're continuing to make positive changes and going in directions that lead to positive outcomes, you'll be successful. It's hard to fail, if you have a large group of people all working in the same direction.
Yeah, and I think it's also hard to fail if you have enough time,
Mhm.
right? Because you can course correct, you can, learn from your mistakes, you get better as time goes on or whatever. But again, going back to kind of this equation for work, um, if it's got to happen tomorrow, then you may need, you know, too much of a Herculean effort today. But if you can be patient and wait 6 months or a year, you can really break that up into stuff that
Well,
very achievable on a daily basis, right?
well, but see, that's the problem we have in society in general today.
We
is,
want it now.
yeah, it's just, it's a lack of patience. It's like, I'm gonna go do this. I'm gonna make this investment. And if it doesn't immediately turn $100 into $1 million tomorrow, I was like, it didn't work, right? So quit, gotta do something else. But see, that's the surefire way to failure, because you're just continually jumping from one thing to another. You're never completing anything. And I see that a lot with the kind of the younger people that I come into contact with. Their biggest impediment to maintaining, a career trajectory, or maintaining, meeting goals, those type of things, is just a lack of patience. And, if they're not getting immediately promoted, they're quitting that job and going to look for another one. That's not the way the world works. And, you've got to go above and beyond. You have to do more than is expected. You've got to put in the time, do the grind, all those sayings that go on. But, you've got to have the patience to allow that to inure to your benefit over time. The same thing with investing, same thing with anything else. It takes time. And I can't tell you, I get a lot of emails from your viewers, and they're like, I've got, just a little bit of money to invest, but I want to retire in 10 years with $5 million. That's not going to happen. The markets aren't going to do that work for you. But what will work is creating cash flow for yourself, saving money, investing your savings. That's the hard work, and it takes a long time and a lot of patience, but it will work, and you will create a lot of wealth. But the onus of building wealth is on you, and it takes time to do that, and you've got to be willing to make that commitment, sacrifice to do it. The markets aren't going to do it for you. But we've been training people for the last, 10 years in all these, advertisements on television and Robinhood and all this other stuff. It's like, hey, invest your way to wealth. That doesn't work. You can grow your savings and grow that into wealth, but you can't invest your way to wealth. That's not the way it works, because what will eventually happen is, if you treat the markets like a casino, it'll treat you like a casino, and it'll take all your money.
Yeah. Yeah. All right. Well, look, my parting comment on this is, maybe reframe, how you look at time. A lot of people might be like, hey, here's what I want to do, right? I want to get in shape, or I want to get my employees really bought into the company, right? Or I want to have X amount, in my portfolio by at some point. And you do the math, and you say, all right, well, look, if you've got capacity to put this much effort in on a regular basis, it's going to take you X amount of time, right? And most people be like, oh, it's going to take me years. Well, no, screw that, right? Where I would look at it and say, hey, congratulations, you can do it. You can get it done. So get started. You can get it done. You can get it done on a manageable timeline, as long as you just have the commitment and the consistency and the discipline, which is all fully under your control, right? So like, congratulations, like you actually can achieve this big, hairy goal. And I think, to your point, Lance, a lot of people just eject when they think, oh, well, it's not immediate, well, then forget about it. But going back to Andy Dufresne, he never would have gotten out of prison if he hadn't, realized, I can do this. It's going to take me X. Let me get started today, right?
And
All
every
right.
day he did the same thing every
Same
day.
thing every day. Yep. And as we talk a lot about, this applies to everything, in your life. Yes, it applies to your money, but it applies to your learning and your knowledge. It applies to your health and your fitness. It applies to how to build working, functional relationships. They all take time. And, just again, if you can find a way to have just the doable amount of daily effort that you can put into it, over time, you will progress towards your goal, right? So anyways,
Absolutely.
look at time as the most important asset you have, and put it to work for you. All right. Well, look, Lance, thanks so much again for today. I'm going to say thanks in advance for the fun time I know we're having in Houston while everybody's watching this.
Yes.
Just a reminder for folks too about events. I'll have the details coming forthwith, but we have locked in a date for Thoughtful Money's spring conference. It's going to be Saturday, March 15th. So just mark your calendars for that, and I'll have data coming out of that in the next week or two, all the details. Look, if you think the best way to use your time going forward is to continue to watch Lance on this channel week after week, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. I can say one of the best uses of your time is to sit down with a good professional financial advisor who understands all the issues that Lance and I have been talking about here, and put together and or refine your plan for how you want to achieve your financial goals going forward. If you don't have a good financial advisor to do that with, consider talking to one of the ones that Thoughtful Money endorses, perhaps even Lance and his team there at Real Investment Advice. To do that, just fill out the short form at thoughtfulmoney.com, and the firms will be in touch with you right after that. By the way, when you're there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of their website to sign up for our free Substack. All right, Lance, thanks so much again, buddy. I'll let you have the last word.
That's right. And I will see you on Saturday.
All right. Everybody else, thanks so much for watching.